I had bought my seventh rental property, and with every single one, insurance was a massive pain point. And in one case, it was the difference between turning a profit on the property versus having a pretty significant loss every year. There was a case where somebody had a very nice short-term rental property, and unbeknownst to them, somebody had rented it to film a music video, and they painted all the walls black, just absolutely trashed the property, and it was going to cost something like $400,000 to repair.
Oh my gosh. Welcome to another episode of the STR Sisterhood. I'm your host, Stacey St. John, and I am so excited to spend some time with you today. Now, before we jump into this episode, you know it, I am going to share a quote with you that I recently read. And it says, "I say if I'm beautiful, I say if I'm strong, you will not determine my story. I will." Those powerful words come to us from American actress Amy Schumer. Now, I'm here to ask you, what would happen if your short-term rental burned down tomorrow and your insurance didn't actually cover it? In this episode, I sit down with Darren Nicks, founder of Steadily, to break down the hidden risks most hosts are unknowingly taking and how to protect your property and your business before it's too late. So without further ado, let's jump into my conversation with Darren. So today I am joined by Darren Nicks, the founder of Steadily Insurance. Darren, this is so fun to have you on the show. Thank you for being here.
I can't wait. It's going to be super fun.
I have to tell you, there aren't many men who are on the STR Sisterhood podcast.
I am honored.
No, we appreciate your partnership, and I'm really excited to have a candid and hopefully super helpful conversation about insurance. And I have to say, insurance is not the sexiest thing to talk about, but it's something that's so necessary, right?
It is. I mean, I didn't come to insurance with intentionality. It happened to me entirely by accident, out of necessity. I had bought my seventh rental property, and with every single one, insurance was a massive pain point. And in one case, it was the difference between turning a profit on the property versus having a pretty significant loss every year because it was costing me so much to insure it. And after 3 to 4 years of that happening over and over again, I began calling up my colleagues from the insurance industry and saying, why is this so hard and so expensive? And they're like, well, there's not really anybody that focuses on doing this well. So you're kind of getting the remnants of the homeowners insurance industry. And that was what led years later to the creation of Steadily.
So take us back before Steadily existed and you were being impacted by, obviously, steep insurance prices. And what gave you the inkling, hey, I'm going to start an insurance organization? What did that look like? How did this start from the beginning?
So I had a little bit of history, or an unfair advantage, I like to call it. 20 years ago, I was a software developer and working at a consulting company, and my clients were all insurance carriers, State Farm, Liberty Mutual, The Hartford. And at the time, the work that I was doing was, this is in like the early 2000s, was helping people to be able to go online, type in their driver's license number and get a quote in a few minutes. And so I had done that in auto insurance, but I didn't know anything about homeowners insurance. And so I knew what good looked like in other types of insurance. And so then when I got to insure my rental properties and I experienced bad, I said, well, look, it can be much better. It doesn't have to be crazy expensive, and it can be fast and easy, but I know it takes a lot of work because I've done it for auto. So then the questions that I was having to my folks, my friends in the insurance industry was, okay, we did it in auto. What does it take to do it in landlord? And the answer was, do you have 5 to 8 years and $100 million? Maybe you can do it.
Okay, well, tell us more about that. So
it probably doesn't come as a surprise that insurance requires a lot of money. You, as an insurance carrier, you have to have enough cash on hand at any given point that if a big storm comes through, you can pay out all of those claims. So it's like a bank. You just have to have a lot of money in reserve. And so it takes a lot of capital to start an insurance carrier. And because it takes so much capital to start an insurance carrier, people want to see a long track record before they're willing to invest that money into you and to give you that financial backing. And so back in 2020, when we started the company, we wrote an 8-year-long business plan because we thought it would take roughly 8 years before we could get to a national scale. We did it in 5, so we're very happy about that. But it's a multi-year journey, and insurance for many people is the work of a lifetime, and I hope it will be for us as well.
So let's talk a little bit about the short-term rental industry. Obviously, that is where my audience who listens and watches this show lives. But many of our colleagues in this industry are also investing in long-term rentals and mid-term rentals. Talk to us a little bit about what you see are some of the biggest misconceptions folks have about insurance before they ever get to filing a claim.
The biggest misconception that folks have is that insurance has to be expensive. And the reason why is because I think a lot of folks come into insurance initially with the goal of having it pay for everything. Anything bad happens to the property, insurance is going to cover it. And that type of insurance is very expensive. And so their initial instinct is right. Like that type of coverage, let's put it into specific terms. If somebody wants coverage for any time a guest breaks a window and they have a $500 loss to get somebody out to replace it, or anytime there's some discoloration on one of the panels and it's a $1,500 claim, every time an insurance company touches a claim, they lose about $1,000 just touching it before they ever pay out any dollars, just having the people come and look at it, send someone out to take photos, all that stuff. And so those small claims are really, really expensive relative to the amount of money that actually gets paid out in the claim. And so if somebody wants something like a $500 deductible on a policy, that's going to be really expensive. The way to be able to have insurance not be expensive is to think about insurance as the last resort, the safety blanket, when something catastrophic happens. So then you're now talking about, okay, what if I ran a $5,000 deductible and I, obviously before upping your limits to $5,000, you started squirreling away some money in the bank account to pay for those $500 annoyances when they happen. Then you can call your insurance company and say, hey, I want to go from a $500 or $1,000 deductible up to $5,000 or $10,000 because I only want coverage for the really bad things that happen that are catastrophic. I'm talking about like a $30,000 broken pipe claim, a, God forbid, $1 million liability claim because somebody got severely injured on the property, like the really bad stuff. Your policy might cost half as much. And so that's the thing that I encourage folks to do as they mature, as their portfolio gets bigger, is to think about building up a big enough nest egg to where they can sort of act as their own mini insurance company. So they're the first line of defense, and their insurance policy is just the backstop for the really big stuff. Because in the end, think about this. If an insurance company is going to pay out $1,000 in claims, they still have to pay their employees. So on average, for every $1,000 that an insurance company pays out as a claim, they're having to collect $1,500 in premium.
Okay.
And that $500 difference is coming from you as the policyholder. And so for every dollar that you can self-insure, you're just paying yourself like free rewards and free income by virtue of having built up a big enough nest egg that you can handle some of the small stuff. So that's tip number one. But I recognize it's only really possible once someone has been doing it for a while and built up a nest egg through a successful and profitable renting experience. It took me a couple of years before I got to that point.
Super interesting. I'm curious today, does Steadily, I know you said you've got national coverage, you write policies in all 50 states. Are all the areas of all the states covered? So if anyone, wants to get a quote, no matter where they live, they can? Or are there still pockets perhaps that are not able to be covered? What does that look like?
When we look at it, it's less than 1% of the time that we actually have to say no. There are, I would call it like the bread and butter, which is about 93% of the country can be an instant yes.
Okay.
6% requires like external photos and it's more work. Like it takes 2 or 3 days to get those insured, but we can eventually get to a yes. Think like hurricane exposed Florida, for example. You have to do the four corners, like it's more work. And then 1%, there's just nothing we can do for them. And that's some really strange properties. Like, I mean, we see everything. There are some houses that are dugouts in earth where, the house, it's kind of like a hobbit house. You're just like, we don't have any way to put a price on what the risk is of like the mold and the water and then the mudslides. Like, I'm sorry, but those are pretty rare. Almost always we can find a policy for someone.
Okay. Good to know. Can you talk with us a little bit about the differences between a short-term rental policy and a standard homeowner policy? I do hear a lot of people say, "Oh, I just have my, my regular homeowner's insurance policy or a regular landlord policy for my short-term rental." And, I think a lot of people don't realize that short-term rental activity specifically is prohibited in some of these policies. So what are the key differences and what should people be watching out for?
There's two differences. One is eligibility, and the second is what it's going to pay for. So eligibility is pretty simple. Historically, properties that are occupied by or that are rented on a short-term basis have more claims. And so the insurance company is like, well, if I'm going to pay out more claims for this policy, I need you to tell me that up front so that I can charge the appropriate premium for it. So if somebody is misrepresenting that it's a long-term rental when it's actually a short-term rental, and then something really bad happens, like, again, we see everything. There was a case where somebody had a very nice short-term rental property, and unbeknownst to them, somebody had rented it to film a music video, like an MTV style music video. And they painted all the walls black, just absolutely trashed the property. And it was going to cost something like $400,000 to repair.
Oh my gosh.
And so at that, if a small claim comes in, the insurance company is probably not going to look too deeply into why it happened. But when a $500,000 claim comes in, everybody's going to make sure that all the I's were dotted and the T's were crossed. And in that situation, it was like, oh, you were short-term rentaling us, and that would not have happened if it had been a long-term rental. So many questions were asked of that claim. Number two is what it will pay for. And typically, a basic long-term rental policy assumes that the property is, one, not furnished. And so it's called contents coverage. A long-term rental policy assumes that there's very little contents. You might have like a fridge or like a washing machine, but it's basically empty. So they might give $10,000 worth of contents coverage. A nice Airbnb may have a lot of contents. And the way to think about contents is, imagine if 200-mile-per-hour wind blew through the property and everything that wasn't attached to the walls blew out the front door. And then you needed to go and replace it all. How much would that cost? Very often the answer is like $50,000 or more. And so you want a real level of contents coverage. That's number one. The second thing that a short-term rental policy will cover is for things that your tenants do to the property. So if people step through chairs and they fall out of windows and they pull fixtures off the wall, because I just heard about this one last weekend. The tenant or the Airbnb did not like the lighting situation in one of their rooms. And so they grabbed a sconce off the wall and just ripped it off the wall and then just moved it to where they wanted light. And that was a $1,000 electrician bill. So these kinds of things happen, and you can get coverage for those types of damages if you don't want to foot the bill yourself.
Gotcha. Don't you wonder how people sleep at night? Like,
insurance.
That is mind-boggling.
Sleep at night.
Right? Right. So we talked about some of the differences in coverage. What are the most common gaps that you see that hosts don't realize they have a gap in?
Underinsuring their property. So it's very tempting when someone is buying insurance coverage to say, well, let's just insure it for $200,000. Maybe that's the amount of their mortgage or something like that.
Okay.
But then you start thinking, okay, if this property burns down to the ground, which, given enough time, it will eventually, hopefully not to you, but to somebody it will, or a tornado blows it down, et cetera. What's it going to cost to rebuild that property? And very often The answer is around $200 to $250 a square foot. And so if you are sitting on a 1,000 square foot property, it's pretty small, but let's say it's 1,000 square feet,
Mhm.
you're looking at $250,000 to rebuild that property. If you're sitting on a 2,000 square foot house, a little bit bigger, you're now looking at $400,000 to $500,000. And so for folks that have skimped on their limits, they might have bought a $200,000 policy, $300,000 in coverage. And so the insurance company will write that check up to the max policy limit and then say, here's your $300,000. And they're like, but the contractor is telling me it's going to be 450. Where's my extra 150K? I can't
Yeah.
rebuild it. They're like, well, that's the replacement cost that you wanted.
Hmm. That is a really interesting point, and I've never thought about it in that light. So if I buy, let's throw out a scenario, I buy a 2,000 square foot house and I pay $350,000 for it. Okay. If I am going to, heaven forbid, have to rebuild it, I'm going to pay, I should have picked easier math, but $450,000
Yes,
ish.
exactly.
Okay. I would have never thought about getting insurance for more than I paid for the house.
And it goes both ways because what you paid for the house doesn't typically have that much of a relationship with what it costs to rebuild the house. So
Okay.
let's say here in Austin, in this neighborhood where I live or where our office is located, a single family plot of land with nothing on it is 800K.
Wow.
And so you might buy a property for like 1.2 million, but you don't need to insure it for 1.2 million because you don't need to insure the land. And so you're like, okay, it's 1,000 square foot like bungalow, $250 a square foot. I only need to buy $250,000 worth of coverage on my $1.2 million property.
Mm.
And that's perfectly fine. Flip side, let's say you buy a rundown house in a distressed area. The property might only cost you $80,000, $100,000. But if it gets plastered, it's going to cost you way more than that to rebuild it.
Right. Interesting. So you need to look at land value.
You need to look at the replacement cost. Yeah. So one way to do it is the simple math I just threw out there is like $200 to $250 a square foot. In California, it's going to be closer to $300 to $350, right? It varies by neighborhood. But you can just, Google or ChatGPT is your friend. Just say, hey, in my zip code, what's the typical cost per square foot to replace insert square footage of your house? And the number that it comes back with is going to be ballpark correct. And then you compare that to how much coverage you're looking to buy and just make sure they're like roughly in the ballpark of each other. So most of your folks are probably transacting on their properties fairly recently. So the second thing I'm going to talk about is not as relevant. But something you'll run into on the homeowner side is somebody might have bought a property 9 years ago and they insured it for $400,000. 9 years go by. It's still insured for $400,000. But now the market has moved on and that property costs a lot more to replace than it did 9 years ago. That happens in Austin all the time. And so insurance is one of those things that you can definitely set it and forget it for like 3 to 4 years at a time. But then you want to check in and just be like, hey, for what I'm doing today, for how I'm using the property, for what's going on in my neighborhood, am I still good?
Yeah. Okay. So every 3 to 4 years, look at your policy and make sure you're still in a good spot. Interesting. Darren, I would have never known that. So I feel like I need to go look at my insurance policy now.
I look at it every year. It's not what I run an insurance company and I don't look at my own insurance policies every year, but whenever anything changes is when I go to look. So like if I'm going to have a vacancy for, a month or two, or if I decide to switch from like an STR to a midterm furnished rental, like those moments when things are changing, that's when I'll just fire off an email to my insurance agent and say, hey, I'm planning to do this. Am I covered?
Right. Okay, so let's talk about that. Should there be any changes in insurance if someone is moving from a short-term rental to a midterm rental? And talk to us about what those changes are, number one. And then number two, a lot of folks will run a hybrid model. So they're short-term running part of the year and midterming another part of the year. What does that look like from an insurance perspective?
Generally speaking, it's going to cover both. And
Okay.
so I don't want to speak for every insurance carrier. So it's a one-line email to your agent to say, hey, I'm planning to do this. Is this okay? And if they say yes, then you're good, like problem solved. One thing that folks are often surprised by is the vacancy clause in a policy. So we'll talk about that. This bit me. I lost $30,000 last year on a vacancy clause on my property. So I had this property in Chicago that I wanted to sell. And I had this incorrect idea that it would sell better if it was vacant and an owner, an owner could move in and then rent out like the sub basement. So I waited until the last tenant moved out and then I listed it for sale. And I was a little aggressive on how much I wanted to sell it for. So it sat empty for 2 months.
Mm-hmm.
And then I got a call from the neighbor and he says, hey, I think there's somebody in your property. And keep in mind, this property's in Chicago and I live in Austin. So I hopped on the next flight. I go up there, call the police, and there were like 5 people that had thrown down cots. And they had gone through with a hammer and they had just polka dotted the walls. They hadn't ripped out the wires, thankfully, which they sometimes do, but for whatever reason, they decided to like poke it off the walls. And so then I called my
But did they
insurance
move
company.
any sconces? No, I'm kidding.
It's a great question. So the police got them out, got a contractor out there to begin doing the repairs. It was going to be like a couple of months and then pipes broke because it was the winter and it was just a whole thing. And so I called my insurance company, who was not Steadily. And I was like, hey, I think I need to file a claim. And they were like, okay, tell me the circumstances. They're like, well, the property had been vacant for 90 days at this point. They're like, your policy doesn't cover a vacancy after 30 days. I was like, oh man, I knew this and I forgot. And the reason why policies have that is that when somebody is in the property, even if they're a bad tenant and they're not paying their rent, if they're in the property, they'll notice if it catches on fire and they'll call 911. They'll notice if water starts pouring out of, the rafters and running down the walls. They'll call you before it turns into mold. So having somebody in the unit keeps the worst things from happening. And when it's vacant, weird stuff happens. And so that's the reason why most insurance policies will have some time limit on how long a property can be vacant. And then coverage stops for any damage that results from the vacancy. So just if you're going to be doing some work on the property and you're not going to have people in it for a while, think about that because bad things happen when properties are empty.
So what is the best way to navigate that? Let's say you are going to renovate a property and you're going to block off your calendar for 3 months while you're renovating it. What are the best steps for someone to take to make sure they are covered in the best way?
You send an email to your agent and say, this property is going to be vacant and I need coverage for it. And they'll respond in any number of ways. But the most common way is they'll say, hey, okay, I'm going to endorse your policy for a vacancy. And it's going to cost you an extra $300 over the next year. And then you tell me when it's no longer vacant and we'll take that off and you get a prorated rebate for what you didn't use. So it's not that much more expensive, but you have to tell them ahead of time. If you wait until the bad thing happens, then you're like, I need vacancy coverage. It's too late.
That's really interesting. And so is that vacancy coverage something that can be a part of the quoting process? So like if someone is getting an insurance quote and they say, I want to have 90 days worth of vacancy instead of 30 days. Is that customary?
So on right now, if somebody goes on to steadily.com, one of the questions it's going to ask them is, are there people in the unit right now? And if not, is it vacant? Are you renovating it? Whatever. And if they say yes, then it's just going to automatically apply that vacancy surcharge. And then as soon as the property is no longer occupied, they just send an email to support@steadily.com. They're like, hey, I've got people in the unit. I no longer need the vacancy coverage, and their premium drops.
Wow. Okay, cool. Again, I would have never known that. Super interesting. You're teaching me all kinds of things, Darren. I appreciate it.
I'm glad. And we haven't even gotten to talk about skiing yet.
I know. So prior to us pressing record, I learned that Darren is an avid skier. And I'm quite impressed. But he tells me that his wife is a better skier than he is. So
she very much is. We'll have to have her on next time.
There you go. Now, I do have a silly question. Can you insure your own properties?
The very first policy that Steadily wrote was on my rental property in the suburbs of Indianapolis? So the answer is yes. And I did a lot of research into that before we did it. And the answer was, as long as the underwriter who reviewed the property is free of conflicts and like applied the same standards. And secondly, when you have a claim, you don't lean on the claims team, then you can do it. And it's fairly common. Fortunately, I had no claims. And so it never became an issue, but yes, you can.
Interesting. Okay. All right. Speaking of claims, how do previous claims impact your insurability or the
Massively.
premium? Talk to us about that.
Just massively. The single best thing you can do to reduce your cost of insurance is to not file a claim. Now, this is why I talked about at the beginning about the importance of having high deductibles. Because if you're running high deductibles, the simple math says that you're not going to file as many claims because the small stuff you're going to be eating yourself. And so you will build up a track record over time of being a person that doesn't file claims. But the single greatest predictor of whether or not a property is going to have a loss is that it had a loss in the past.
Okay.
It's like massively correlated. And so if you take somebody that has had, for example, 2 claims in the last 5 years, odds are they're going to have another one in the next 2 years. And if you take somebody that has had no claims in the last 5 years, odds are they're going to have none. And that's going to be very reflected in the price that they pay for insurance. And so having those higher deductibles keeps you in a reputation of being somebody that doesn't file claims. Now, every time I say this, I want to caveat, insurance is there for a reason. And so if you have a big loss, you should absolutely file the claim. Like that's what it's for and you should use it. But avoid the things that are marginal, because that $2,000 claim that you're going to get paid if you file it over the next 2 or 3 years, you may end up paying more in insurance because your premiums went up so much as a result of having had that claim.
And Darren, if someone has multiple properties in their portfolio, let's say they filed a claim on property A, but they're not getting an insurance quote for property A. They're quoting a new property, property B. Does that history on property A show up during that quoting process?
I love this question because it goes to the heart of the difference between an insurance company that is built for landlords versus an insurance company that's built for homeowners. So in a homeowner's model, yes, it's all just a claim. And they're like, oh, you had a claim on your home. But they don't distinguish that it was a rental property and how many rental properties you had, et cetera. So it would hit. Whereas a landlord insurance company would say, oh, we recognize that somebody might own 1, 2, 5, 10 rental properties. And so we have to think very differently about somebody that's had 3 claims if they had 10 properties versus somebody who's had 3 claims if they had 1. But only a landlord insurance model is going to account for that distinction.
Interesting. Talk to us a little bit about liability insurance. So what happens, again, if a guest comes into a property and they slip and fall or they injure themselves? How does Steadily look at that? What should folks be looking for in their insurance policies?
Liability is fortunately one of the cheaper insurance dimensions to buy more coverage of. A typical policy is going to start with like $300,000 to $500,000 worth of coverage, and then it can go up to $1 million or $2 million, even $5 million if you go up to like an umbrella policy. Personally, I like to carry roughly the amount of my net worth in liability coverage, because the juicier target someone is, the more aggressively a plaintiff's attorney is going to go after them to get a payday. And so if somebody doesn't have a lot of assets, the plaintiff isn't going to spend all that much time going after them, but like it scales up. So that's one thing to think about. The reality of the expense of litigation, if any of your listeners ever been involved in litigation, is that $250,000 is about the entry point just to defend a charge, like to defend a lawsuit, even before you've like lost a judgment. And so that's what like a $300K gets you. It gets you a legal defense. But if you lose the case, you're probably already tapped out, and whatever judgment you get against you is going to come out of your assets.
Hmm.
And so it starts to get up into like the 500,000, million plus of liability limits before you've actually got real protection in the event
Hmm.
that you lose a judgment or a settlement, as often happens.
So interesting. So interesting. So your recommendation is to look at your net worth and perhaps have coverage that is similar to your net worth. At a minimum, though, you feel like, I don't want to put words in your mouth, but $300,000 may not be enough coverage.
It's definitely not enough. It's not enough if you want to actually be able to pay off a settlement or a judgment without it coming out of pocket. It's enough for legal defense, and that's about it. And so I feel a lot more comfortable when folks are running 500K to $1 million in liability. And I don't want to be one of those people that sitting where I am selling insurance saying, just buy more insurance,
Right.
which is why it's sort of a split recommendation, which is on the one hand, run higher deductibles, which lowers your premium. On the flip
Mhm.
side, buy more liability coverage because insurance is supposed to be there for those very expensive catastrophic events that don't happen very often. And liability is exactly that. Hopefully you'll
Right.
go your entire career as a property investor and never have a liability claim. But if you have one, it's going to be a max limit claim every time.
Interesting. Okay. Talk to us about some other things that folks should be, if they pull out their policy and they're like, hey, I feel like after listening to Darren, I need to review it. Talk to us about anything else in their policy that they should keep a close eye on.
We covered the important parts, which is the replacement cost coverage, the deductibles, and then the liability limits. Those are the big ones. 2 or 3 years ago, this was hard to do because policy documents are long and no one wants to read them, not even me. But now you can take the PDF of your policy document, drop it into ChatGPT, and just say, hey, I've got a hot tub in the backyard and I want to know if it falls through the porch and blah, blah, blah happens. Will my policy pay for it?
Mm-hmm.
And ChatGPT, most of the time, will give you a pretty solid answer. And so that's the way that, for example, with the vandalism clause, the next time that I was looking at a policy, I didn't go and find the vandalism clause on page 72 of my policy. I just popped it into ChatGPT and said, hey, what's my days limit on my vandalism?
Mm-hmm. Love that. Love that. Love that. Okay. So I want to ask you, if someone is already running a short term rental and perhaps they are house hacking. I know a lot of people do this where they'll rent out a room in their home. So they're living in their home, but they're also renting it out. How does that impact their insurance requirements?
Generally speaking, in that situation, they're just on a conventional homeowners policy because they've got all the contents, they've got all the other things with their family, et cetera. And so that's going to be a homeowner's policy. And then you, at the point where you decide to rent it out, you send an email to your insurance company and you say, hey, I'm planning to rent out this room. I just want to make sure I'm covered. And if the insurance company replies and says, you're covered, like it's in writing. And so that's all it takes is just an email to make sure that you're in good shape. And that's usually perfectly fine.
Okay. And then, same type of scenario. I also know some people will live in their house, let's say 9 months out of the year, and then 3 months out of the year they travel and they're renting it out. Same type of scenario. Message your agent and say, "Hey, am I covered, or what coverage do I need?"
Exactly. And usually you're not talking about a massive difference in premium one way or the other because they've already got the relationship with you. You already got a history with them. And generally speaking, it's going to be like, okay, I have to tack on this thing for this period of time and then let me know when I can take it off. And you're talking about hundreds of dollars, not thousands of dollars. And so my recommendation is be forthcoming with your agent and just let them know when something's changing.
Mm-hmm. Okay. And going back to a property that is a short-term rental, are there any key recommendations you have about safety in the home, or making sure that guests are properly cared for when it comes to a safe property? Again, I'm just thinking about liability. I know you said it's a cheaper aspect to insurance coverage, but any ways for hosts to be able to protect themselves here?
Yeah, I love it when I get the email from the host that says, hey, here's your unique passcode that's going to start working at this time, and it will stop working at this time because, at least from an insurance perspective, I know that then if something happens, they can say, hey, I did my diligence to make sure that the prior tenant wasn't just going to be able to come back into the property the next day and do whatever they wanted to do. And
Mm-hmm.
so just thinking through not necessarily from an insurance perspective, but just purely from the safety of your guests, what are the little things that you can do that you would hope that a host would do to keep you safe in a world where folks are coming in and out and strange things happen to
Mm-hmm.
properties? So I'd leave it at that.
Okay. Last question before we move to the lightning round. If you are talking to a brand new property investor, what is the best piece of advice you would give to them?
Buy a property in a city that you know very well, that you can keep close eyes on until you've built the reps of knowing the ins and outs, because there are so many surprises
Mm-hmm.
of things that will happen. And if you have the ability to drive over to the property and take care of it, it makes owning a rental property so much less painful than if you're having to call your property manager in a different state to try to go out and take a look and get squirrels out of the attic. Ask me how I know.
How do you know, Darren?
I did everything wrong. It was just like every rental property that I owned, it was just like a YouTube video of don't do this.
How did you get started? I know I said that was the last question, but now I'm curious. How did you get started buying investment property?
I had wanted to become a property investor for a long time. I was sold on the idea that this is a get rich slowly opportunity. And I'm like, I'm a patient person. I'm in insurance, like I can do
Mm-hmm.
this. And so I did one thing right, which is I said, I'm only going to buy in cities that I've lived in, in markets that I knew. The problem is I now live in Texas, and most of the places that I've lived in are on the other side of the country. And
Mm-hmm.
so I bought in North Carolina, in Indianapolis, in Chicago, in Kansas City. And some of them appreciated, some of them didn't. But all of them were very difficult to manage from afar
Mm-hmm.
until I got the right people in place.
Mm-hmm.
And getting the right people in place took 3 to 4 years. And a lot of money was wasted in the interim. And so if I had to do it over again, I would have approached it with what I know now of making sure that I had the infrastructure around running that property and anticipating that bad things are going to happen, so that when they did happen, it wasn't going to cost me an arm and a leg to get them taken care of.
Mm-hmm. Mm-hmm. So you lived in Indianapolis. That's interesting. I grew up just south of Indianapolis in Columbus,
Yeah.
Indiana. I don't know if
Very
you,
first flight lesson I ever took was in Greenwood, Indiana.
I'll be darned. We used to
Yep.
go to the Olive Garden in Greenwood all the time.
I know exactly the one you're talking about.
So fun. Okay, Darren, we're going to move to the lightning round. All right.
Okay.
So I'm going to ask you a few questions and hopefully they're easy, but you have to answer with the very first thing that comes to mind.
Okay.
Okay. First question is, where is your favorite place to vacation?
Telluride.
Okay. That does not
Steer.
surprise me. That does not surprise me. When was the last time you went there?
2 years ago.
Okay. Well, you
We
might
don't get to get up there very often. It's difficult to get to.
Mhm.
It's a hike from Denver, but when we can finagle it, we do.
Okay. What's one place you've never been that you want to visit?
Prague, easy.
Okay. Now that is an interesting answer. Tell us what makes you say that.
All of my friends seem to have been able to make it to Europe like multiple times and talk about how great Prague is and all these places they've been in Europe. And I've, on a layover or something, I can technically say that I've been to Europe, but I haven't really been. And so it's on my bucket list.
Mm-hmm. If you went over, I would say you'd have to go for like 2 weeks, right?
Mhm.
Would you go to other places beyond Prague?
Oh, absolutely. I mean, it's, from what I understand, you just hop on the train and you can see 5 countries in a week
Yep.
as opposed to.
Yeah.
Yeah.
It's pretty amazing. I went to Italy. We did a Mediterranean cruise last year. It was in Portugal first, and then we spent a couple days in Italy, and then we did a 10-day Mediterranean cruise. And I mean, the food, the sites they're unbelievable. They're unbelievable. So you gotta do it.
Fingers crossed.
Yes. Okay. Next question. What's one thing you know now that you wished you knew when you were starting out in the world of insurance?
Your team is everything.
Oh, yeah. Love it.
I In the early days, I made so many mistakes in hiring and was so fixated on, well, I can only afford to pay, this much money for this role. And these days, it's sort of the opposite is I have to have the very best person that I can find. And if that means I have to have a tiny team because I can't afford to hire more people, so be it. But I need to be
Mhm.
surrounded by people that I trust who are the best in the business. And that's the thing that I think I did wrong for many years in the early part of my career.
Amen. So, what is your practice for identifying the best people? How do you know when they're right for you?
We do something fairly interesting at Steadily. So, in almost every role at Steadily, when you get to the final round of the interview process, we don't have you come in and spend 10 hours interviewing with various people. We instead hire you for 2 days and we pay during those 2 days. And to the greatest extent possible, we have folks do the role that they're interviewing for 2 days. And so
Mhm.
in engineering, it's pretty easy. You can just set them up with a development department and they can code, and that's very telling. You can do it in sales pretty easily, and customer service you can do easily. There's some roles that it's much harder for, like legal, but we work very hard to do that approach. And it makes it a two-sided process where we're getting to see them in action, but they're also getting to see us. And in the natural
Mhm.
course of events, they're on Slack, they're reading documents, and they're engaging and putting out their ideas. And so by the end of that 2 day period, we both have a really good sense of whether we're a mutual fit. And that's allowed us to avoid a lot of hiring mistakes. And also sometimes people are just like, hey, I don't think I'm the right fit for this company.
Mhm.
And we're like, that's awesome. I'm glad we both figured it out before we made a very expensive decision.
That is so interesting. I'm utilizing that model to add to my cleaning team right now. So in my property management business, brought cleaning in-house instead of working with third-party
Mhm.
cleaners. We have our own team. And then last year, I launched a division of my property management company, which is a cleaning division where we're performing cleaning for other organizations as well. And I just instituted that same exact model because I feel like people can say anything in an interview, right? They can say all the right things, but how we're really going to identify is this a good fit is let's see their work, right? So,
100%. And it also allows you to be surprised. So if you're going to see someone do the work, you can rely less on their credentials, so to say, and
mhm,
let folks just show you what they're made of. And we've
mhm,
been able to make some really surprising, amazing hires that on paper
mhm,
wouldn't have gotten the job, but they just
mm,
crushed it during the two
mhm.
day. And so I think it works great for weeding out the talkers and for also opening up the aperture of the folks that you can
Yeah.
consider.
And do you do that for only folks, and maybe all of your folks are based there in Austin, or do you have remote positions as well?
We're about 90% in person. So we
Okay.
have engineering is all here in Austin where I sit. And then all of our sales support and claims is in Kansas City.
Okay.
And then we have a few folks that are around the country, like our actuaries or the folks who do the math and things like that. And so for those roles, it's kind of the same thing. If they do the roles, it's a little bit harder when they're remote, but we make it work
Mhm,
because they're
mhm.
they're amazing.
That's so cool. Love it. All right. Next question. What's the best piece of advice you've ever been given?
This relates to the one that we were talking about before around team. My very first job was as a consultant to like Fortune 100 companies. And there was this one really sexy engagement that was kicking off with this prestigious client. And I told my manager, like, hey, I really want to go and work on that engagement with that sexy client. And he's like, that is not a good team. You don't want to be on that engagement. And I was like, yeah, but it's such a like them what they're going to be doing and like the brand name and everything. He's like, nah, man, it's all about the team. You need to find the very best team that you can work on. And it doesn't matter if you're working on something boring. the fact that you're working on a very strong team, you're going to learn a lot. You're going to make lifelong relationships, like optimize on working with great people. And I did not take his advice at the time, and I regretted it. And then since then, I've worked to apply that advice.
Yeah, that's really cool. I talk about team a lot. And from my own experience, to your point, having great people around you who push you, who aren't afraid to speak their mind, who see the greater good, like our work product is beyond each of us individually, right? So collectively, we want to create the very best experiences for our guests, the very best experiences for the owners that we have the ability to support, for our cleaning clients. But I think it's so, so, so important to surround yourself with people who push you and also are smarter than you.
We at Steadily, when new hires come on board, they'll frequently ask me, what does it take to be successful at Steadily? And the trait that most predicts success across any role at Steadily is ownership. And so ownership means to us that you aren't just passively taking instruction or just checking the boxes. You care. Whatever it is that you're doing, you are owning the job and you are acting like an owner of Steadily. And that's one of the reasons why everybody that joins Steadily gets shares in the company, because we want to foster that true ownership. And it can show up in every company, big or small. The people that care and demonstrate that they want the best for the company, for the customer, for the team, those are the people that you have to hold on to because they're gold.
Yep. Amen to that. All right. Last question. What's one thing and or person that you're grateful for today?
I am grateful for my wife, Christine.
Now, why do you laugh when you answer that?
Because I know she'll see this and she's going to be like, whoa.
Good job, honey. No. All right. Give us the scoop.
We met in a crazy way. So I come from a software company background. And 8 years ago, she was running corporate development for this big company that was interested in buying us. And I had never met her before, but she had been like managing the investment in my company for 2 years. And my two co-founders, unbeknownst to me, said, Darren's really going to like Christine. And so then like late in the acquisition process, we got introduced and it was just like, we hit it off immediately and there was super strong chemistry, but she was responsible for like negotiating this deal to buy my company. And so it was just like, well, wow, this is awkward. And so right around the time that all the papers got signed, we're like, okay, we're dating. And it's just been a great story ever since then for the last 8 years.
That's so cool. So, and how long have you been married?
We've been married now for 2 years.
It's good when you find the right person. You know, it makes life so fun and enjoyable.
It does, except when she beats me at skiing.
Well, we'll just keep that, quiet.
We'll just cut that out.
That's right. Well, that's right. Darren, this has been so fun. You've taught me so much. So thank you for coming on and talking insurance. And again, I don't mean to be disrespectful when I say insurance isn't sexy, but I think that this is so important for us to be talking about to make sure that we're properly protected. For you, you probably do think insurance is sexy, right? You've been in this industry
I like it a lot. I like it a lot. I won't belabor the point, but look, we are here for some of the worst days of people's lives. And I'm glad that the product that we make helps out a lot of people.
And so if folks want to get a quote, we'll drop a link in the show notes. We have a special page to go to, and I would highly encourage everyone to connect with the Steadily team, have them review your policy, and they can help you identify if there are any gaps that you should be looking at. So, Darren, appreciate your willingness to have your team help our community.
It's my pleasure to be here. Thank you for having me on.